The global financial system that most people trust today is more fragile than it looks. For more than 100 years, banks, correspondent networks, and payment rails like SWIFT have controlled how money moves across borders. But right now, something historic is happening quietly in the background. The old system is not being attacked from the outside, it is being hollowed out from within, and very few people are paying attention. While most retail traders are staring at XRP's price stuck between $1.91 and $1.95, something far more important is unfolding behind the scenes. The plumbing of global finance is being removed and replaced. This is not about hype, memes, or short-term price action anymore. This is about infrastructure. This is about who controls liquidity in the next financial era. Welcome back to We Are Cosmic, the channel where we don't chase candles, we track systems. If you are new here, this channel is focused on understanding finance, cryptocurrency, and institutional money from a long-term strategic perspective. We don't just ask what the price is doing, we ask why the system is changing. And today's breakdown might completely change how you see XRP. Let me be very clear from the start. What we are witnessing is not a speculative experiment. It looks boring on the surface, but it is aggressive in reality. The traditional SWIFT system takes 3 to 5 days to settle international payments. That delay creates risk, trapped capital, and inefficiency. The XRP ledger finalizes transactions in roughly 3 seconds. That single difference alone threatens the relevance of thousands of banks, branches, and intermediaries around the world. Here's where things get interesting. Retail interest in XRP is clearly declining. New wallet creation is down by roughly 65%. Many people see this as bearish, but at the same time, daily transactions on the XRP ledger have surged to around 1.45 million per day. That is not a coincidence. That is a signal. This creates a paradox. As the hype fades, utility is exploding. The loud crowd is thinning out, but the players replacing them are not retail traders. They are institutions. They move slower, but they move with size. And they do not care about daily price fluctuations. They care about reliability, liquidity, and compliance. This tells us something very important. The value of the XRP ledger is no longer being driven by social media sentiment. It is being driven by necessity. Global liquidity needs faster rails. Banks need systems that work 24/7. Treasuries need settlement without friction. And the old infrastructure cannot deliver that. Ripple is signaling a major shift. The era of constant building is ending. The era of operating has begun. When a company stops experimenting and starts governing, it means the core technology is considered complete. It means the system is now stable enough to handle serious responsibility, including sovereign debt, treasury flows, and institutional settlement at scale. This is why price stagnation can be misleading. Markets often move last. Infrastructure moves first. In today's video, we are going to break all of this down step by step. We will look at why XRP is decoupling from the rest of the crypto market, how institutions are quietly concentrating supply, and why this transformation may not benefit retail investors in the way many expected. We will also ask the uncomfortable questions that most channels avoid. So make sure you watch this till the end, and if you find value in deep, system-level analysis instead of noise, subscribe to We Are Cosmic. Because what is happening right now is not just another crypto cycle. It is the beginning of a new financial architecture, and this time, it's happening without permission. For years, one question held crypto adoption back more than any other. How do you get banks to use blockchain without forcing them to rebuild their entire systems? Banks do not move fast. They do not like disruption. And they absolutely do not like ripping out core infrastructure that has been running for decades. That problem is known as the last mile problem of crypto adoption, and quietly, Ripple just solved it. On January 21st, 2026, Ripple achieved something that most people completely missed. The XRP ledger was directly plugged into the Hogan core banking platform through DXC technology. This is not a small software update. This is a structural breakthrough. Hogan is not some niche banking tool. It is the core operating system for mid to large tier banks across the world. Hogan manages over 300 million deposit accounts and more than $5 trillion in assets globally. If you understand banking, you understand how insane that number is. Hogan is the central nervous system. It handles deposits, payments, reconciliation, and internal ledgers for banks that cannot afford downtime. By integrating Ripple's custody and payment technology directly into Hogan through DXC, Ripple did something brilliant. They bypassed decades of resistance. Banks no longer need to adopt blockchain. They don't need new staff, new training, or a massive IT overhaul. They simply flip a switch. This changes everything. Instead of convincing banks to move onto crypto rails, Ripple embedded crypto rails into the systems banks already trust. That is why this is called an infrastructure play, not a marketing play. It turns the XRP ledger from a visible crypto network into invisible financial plumbing. This integration was led by Ripple's senior engineering leadership, and the goal was very clear. Make the XRP ledger boring, stable, and reliable enough that banks barely notice it is there. That is exactly what institutions want. They do not want excitement, they want certainty. Now think about the implications. Banks can now enable programmable payments, real-world asset custody, and near-instant settlement without touching their legacy architecture. That removes the final excuse. The last mile problem is gone. This is why the impact is terminal for the old system. Ripple is no longer knocking on the doors of central banks and financial institutions. They are already inside the vaults. And this move did not happen in isolation. It is supported by regulation. Ripple now holds more than 75 regulatory licenses globally, including one of the most important licenses in the world, the Electronic Money Institution license in the United Kingdom. That license allows Ripple to operate as a regulated payments provider, not just a crypto company. This is a critical distinction. Ripple has crossed the line from fintech experiment to regulated financial infrastructure. When you combine regulatory approval with deep integration into core banking software, you get something powerful. Whether retail investors buy XRP or not becomes almost irrelevant. The rails are being laid anyway. Major banking groups in Japan and global financial hubs are already being wired into the speed and efficiency of the XRP ledger. This is what silent adoption looks like. Price action does not reflect this because markets trade emotion. Infrastructure moves on necessity. Banks do not announce these shifts with hype. They execute quietly over years, and then suddenly the old system is obsolete. What we are seeing here is not competition, it is replacement. In complex systems, leadership changes often say more than press releases ever could. When the person who designed the foundation of a system steps away from daily operations, it is rarely a sign of weakness. More often, it is a signal that the structure is complete and ready to scale. That is exactly what happened at Ripple. David Schwartz, the co-creator of the XRP Ledger and Ripple's chief technology officer since 2018, officially transitioned out of day-to-day engineering leadership in late 2025. He moved into a governance-focused role and joined Ripple's board of directors. To many retail investors, this sounded like bad news. Fear spread quickly. People assumed innovation was slowing down. But in institutional technology, this move means the opposite. Schwartz has been involved with the XRP ledger since 2012. For more than a decade, his role was to experiment, design, and harden a system that could survive real-world financial stress. That phase is now over. The ledger has reached what institutions call feature-complete status. In simple terms, it works, it scales, and it is stable enough to be trusted with massive value. This is why leadership has shifted from experimentation to execution. The baton has been passed to Dennis, Ripple's former senior vice president of engineering. His mission is not to invent new ideas. His mission is to scale what already works. That is a critical difference. Enterprise systems do not evolve through constant innovation. They evolve through reliability, uptime, and compliance. This marks the moment Ripple stops behaving like a crypto project and starts operating like financial infrastructure. Schwartz himself made this clear in his own words. He described stepping back from daily duties as a personal decision after 4 decades of work, choosing to spend more time with family and return to long-delayed interests. But importantly, he did not leave the ecosystem. He shifted focus. He is now researching advanced use cases for XRP that exist outside Ripple's direct corporate strategy. That separation matters. It allows Ripple to remain conservative and stable, while innovation continues in parallel without risking the core system. At the same time, Ripple's roadmap for 2026 is already in motion, and it focuses on 3 critical pillars that institutions demand. The first pillar is privacy. Using zero-knowledge proofs, banks can transact on-chain while keeping sensitive data hidden. This solves one of the biggest blockers to institutional adoption. The second pillar is programmability. Enhanced smart contract functionality allows complex financial logic to execute automatically without manual intervention. The third pillar is native on-chain lending. This removes the need for third-party intermediaries and allows liquidity to move more efficiently inside the ledger itself. These are not retail features. These are balance sheet features. This is why the timing matters. Banks do not move trillions of dollars onto experimental systems. A feature incomplete ledger is a red light. A feature complete ledger is a green light. And this brings us to a critical moment. The XRP ledger is no longer growing up in public. It is growing into a controlled, secure, and private environment designed for central banks and institutional treasuries. That transition comes with trade-offs. As the system matures, it becomes less exciting for speculators and more attractive for institutions. The wild innovation phase fades, stability takes over. And while that is good for global finance, it raises difficult questions for retail investors. Is this maturity a sign that XRP is finally ready for its real purpose? Or does it mean the era of explosive, retail-driven upside is behind us? That question becomes even more important when we look at what is about to happen next. In just days, a political decision could permanently change XRP's legal status in the United States. In crypto, technology matters. Adoption matters, but nothing moves institutional money faster than legal clarity. Banks can tolerate slow systems. They cannot tolerate regulatory uncertainty. And for years, that uncertainty has been the single biggest barrier holding XRP back. That barrier may be about to disappear. On January 27, 2026, the United States Senate Agriculture Committee is scheduled to vote on the Digital Asset Market Clarity Act. This is not just another crypto bill. It is a structural reset of how digital assets are classified in the United States. And buried inside it is a provision that could permanently change XRP's legal status. To understand why this matters, we need to look at the past. In 2025, Ripple reached a settlement with the SEC that provided strong protection for retail holders. That case removed the existential threat hanging over XRP, but it did not fully resolve questions around institutional sales. For large funds and banks, that gray area was enough to stay on the sidelines. The Clarity Act is designed to eliminate regulation by enforcement. Instead of relying on outdated tests like Howey, it introduces a clear legal framework, and one specific clause acts as a legislative safe harbor. The draft language states that any digital asset that served as the principal asset of a U.S.-listed ETF before January 1st, 2026 shall not be considered a security. That single sentence is a game changer. Why? Because in late 2025, XRP spot ETFs were successfully launched by firms like Bitwise and Franklin Templeton. That means XRP already qualifies under this provision. If the Clarity Act passes, XRP would be legally codified as a non-security commodity, not by a court interpretation, not by an agency memo, by law. That distinction is massive. It means the SEC's ability to challenge Ripple or its partners effectively vanishes. It means banks, asset managers, and sovereign funds can allocate capital without fear of retroactive enforcement. It means compliance departments finally get a green light. This is the final lock in the institutional thesis. At that point, XRP would sit on the same regulatory footing as assets like gold or Bitcoin, not because of narrative, but because of statute. That is how serious money moves. Now, while this legislative process unfolds, there is something important retail participants need to understand. Institutional adoption does not wait for price confirmation, it waits for legal permission. And this vote provides exactly that. If the Clarity Act passes with the required votes, constrained capital is unlocked instantly. Pension funds, insurers, and global banks that were previously barred by policy can finally participate. That does not guarantee immediate price appreciation. Institutions do not chase price. They accumulate slowly, quietly, and strategically. This is why personal risk management matters more than ever. No matter how bullish the setup looks, concentration risk remains dangerous. A redundancy strategy is essential. Never keep all assets on one exchange. Use multiple trusted platforms and maintain access to liquidity across regions. Because as regulation solidifies, infrastructure hardens, and institutions move in, volatility may compress. The market shifts from speculation to allocation, and that is not always exciting for retail traders, but it is extremely powerful for systems. This vote represents the moment XRP transitions from a legally gray experiment into a legally green asset. Once that happens, the institutional bull case stops being a theory. It becomes the law of the land. The question is no longer whether banks can use the XRP ledger, it becomes whether they can afford not to. Every long-term investment has a breaking point, a moment where belief is tested not by bad news, but by endless waiting. For XRP holders, that moment may be happening right now. while institutions are quietly positioning, the retail community that carried this project through its darkest years is fading. The data is clear and uncomfortable. In the first weeks of 2026, new address creation on the XRP ledger dropped by roughly 65%. That means fewer new participants are entering the ecosystem. At the same time, average transaction size is increasing. Fewer users, bigger players. This is the core of what critics call the ghost chain theory. The idea is simple. Ripple has been so successful in attracting institutions that retail investors are no longer the priority. If XRP becomes primarily a bank-to-bank settlement layer, price volatility becomes a liability, not a feature. Institutions do not want explosive upside. They want stability. That creates a conflict. Retail investors were sold a vision of massive price appreciation driven by global adoption. But global adoption may require suppressing the very volatility that creates those gains. Holding fatigue is now visible across the network. Data suggests that more than 50% of long-term holders who waited over 3 years have reduced or exited positions, not because the technology failed, but because time eroded conviction. This is where expectations collided with reality. The bearish case is brutally simple. Banks get the utility. Retail holders hold the asset. If most real volume moves through private liquidity pools, permissioned environments, or stablecoin pairs, the public token risks becoming a secondary layer of the system it helped bootstrap. That fear is tearing the community apart. Social media engagement around XRP has dropped by roughly 40%, even as institutional accumulation hits record highs. Influencers who once stood shoulder to shoulder are now turning on each other. Lawsuits are being filed. Failed price predictions are being revisited. Blame is being assigned. This is what happens when price stays flat while headlines stay bullish. The frustration is understandable. For years, retail investors defended XRP through regulatory attacks, delistings, and ridicule. Now that the system is finally being adopted, many feel like they are being left behind. But there is another way to view this. This transition was always going to be uncomfortable. When an asset moves from retail speculation to institutional infrastructure, the energy changes. The narrative shifts from excitement to patience, from hype to process. The market does not reward that transition immediately. Institutions accumulate when sentiment is low. They prefer quiet markets. They prefer fractured communities. Emotional exhaustion creates opportunity for disciplined capital. That does not mean retail is wrong. It means retail time horizons often do not match institutional ones. This is the real question XRP holders must answer for themselves. Is this asset meant to be traded for short-term gains or held as exposure to a new financial backbone that may take years to fully express its value? Because if XRP's future is as a neutral settlement layer for global finance, the upside will not arrive in dramatic candles. It will arrive through gradual repricing as supply locks up and demand becomes non-negotiable. The danger is not that XRP fails. The danger is that the community cannot survive long enough to benefit from its success. And this brings us to the final piece of the puzzle, the mechanism Ripple is using to solve volatility itself, the asset that may define how value actually flows through the ledger. For years, the biggest argument against using XRP for global settlements was simple and valid: volatility. No bank treasurer wants to move millions or billions of dollars through an asset that can swing 5% in minutes. Speed means nothing if value cannot be preserved. Ripple's answer to that problem is not to replace XRP, but to surround it. XRP is the engine of the system, but RLUSD is the fuel. RLUSD is a one-to-one US dollar pegged stablecoin designed to provide price certainty at both ends of every transaction. XRP handles the movement. RLUSD preserves the value. Together, they form a hybrid financial model that bridges the old world and the new. This is not theory. Ripple secured a $150 million debt financing agreement with the LMAX Group, one of the most respected institutional trading firms in the world. LMAX provides deep, transparent, 24/7 liquidity similar to traditional FX markets. That means billion-dollar transfers can move through XRP without causing price slippage. This is what a liquidity fortress looks like. In this system, banks convert dollars into RLUSD, bridge through XRP in seconds, and exit back into RLUSD or the target currency. XRP never needs to be held for long. It just needs to exist as settlement collateral. That design neutralizes volatility while preserving speed. And this is why the institutional thesis becomes so powerful. As banks, treasuries, and asset managers begin using this system, demand for XRP is no longer speculative. It becomes functional. XRP is needed because nothing else can perform that role at scale with the same efficiency. Now, here is where the numbers matter. Mega whale addresses holding over 1 billion XRP now control a record 9 billion tokens. That supply is not trading. It is being warehoused. As more XRP is locked into institutional custody, the liquid supply available to the open market shrinks. If regulatory clarity is finalized and if integrations like Hogan and LMAX begin processing live volume, demand collides with illiquidity. That is how repricing happens. Not overnight, not explosively, but structurally. Base case models suggest prices in the low double digits if XRP captures a modest share of global remittances. Aggressive scenarios exceed triple digits if the ledger becomes a core layer for trillions in deposits. These are not social media fantasies. They are utility-driven outcomes, but they require patience. XRP is no longer designed for the day trader. It is becoming an asset for entities that think in decades, not weeks. Sovereign funds do not chase momentum. They position early and wait. This is the binary phase. Either XRP becomes the back-end middleware of global finance, or it settles into a specialized role with limited upside. The data today favors the institutional outcome, but timelines matter, and most retail investors underestimate how slow real financial transitions are. While the community may be fracturing, the architecture they defended is now being occupied by the largest players on Earth. The irony is painful. The technology succeeds just as belief weakens. This is not the end of the story. It is the end of speculation and the beginning of operation. If you want to understand how institutions are positioning across the rest of the crypto and financial markets, click the next video on your screen. We break down systems, not noise. This is We Are Cosmic. The old throne is cracking, and the ledger is ready to rule.